Good morning, everyone. I hope everyone can hear me okay. Welcome to our talk on the Common Reporting Standards. Before we get stuck into the topic, I know that there's a few people on the webinar who I have not met before, so please allow me to introduce myself. My name is Richard Creed. I help payment institutions, electronic money institutions, and challenger banks manage their legal risk so they can concentrate on growing good and profitable businesses. I founded Creed Solicitors nearly 10 years ago. It is a niche payments law firm which focuses primarily on the payment institution, electronic money institution, and challenger bank market. Amongst other things, we can draft and amend your customer-facing terms, draft your outsourcing agreements with third parties, review commercial contracts PSPs enter into with suppliers, and provide external in-house legal services. We also act for buyers and sellers of payment institutions and electronic money institutions. And obviously, we can provide legal opinions and advice on the common reporting standards. Now, if you just give me a second, I shall share my screen. Hopefully everybody can see that now. Quick disclaimer, this webinar is meant to be a high-level overview and you should not take it as specific legal advice. An EMI API's individual circumstances must be considered when determining if it falls within the scope of the Common Reporting Standards and what its obligations are. If you'd like bespoke advice on the Common Reporting Standards, please feel free to email me. My email address should be in the chat, or you can also book an appointment through a Calendly link, which is also on the app. Though that Calendly appointment will be free, it's 15 minutes, and we can discuss what your needs are. We can outline how we might be able to help you at the end of the webinar as well. So the talk timetable, just to give you an idea of what we're going to be talking about. I'll firstly do an overview of the Common Reporting Standards. I'll talk about the changes in the scope to the Common Reporting Standards, which is the top subject of this talk. I'll talk about a carve-out from the Common Reporting Standards, which some of you may be able to rely upon. I'll then go on to speak about the obligations if you fall within scope of the Common Reporting Standards, your due diligence obligations, the implementation timelines, what we perceive to be your next steps, how we might be able to help you, and lastly, we'll run over any questions that you may have. So please feel free to drop some questions in the chat as we go, and I'll do my best to address them at the end. So I'm not sure if everyone saw the post, but I posted on LinkedIn a few weeks ago with a poll asking what people's knowledge was on the Common Reporting Standards. It was clear from the responses that not everyone has clarity around exactly what the Common Reporting Standards are and how they might impact electronic money institutions and payment institutions. So in a nutshell, governments around the world are concerned that their citizens are hiding wealth outside of their jurisdiction and are evading tax. Accordingly, the OECD came up with a framework whereby financial institutions are obliged to report the balances of accounts which they have issued, which are held by persons resident outside the jurisdiction, or held by corporate entities with ultimate beneficial owners who are resident outside of their jurisdiction. The hope is that less money will be hidden from tax authorities and more tax will be collected as a result. The legislation which implements the OECD's framework in the UK is the International Tax Compliance Regulations 2015, or the ITC regs. Now, the ITC regs require reporting financial institutions in the UK to identify and report financial accounts to HMRC, which are held by non-UK residents or are held by UK entities whose income is mostly passive and which have UBOs, which are resident outside of the United Kingdom. Now, as things have traditionally stood, it is mainly banks and investment companies that have been subject to the ITC regs. The ITC regs as they are currently drafted, or have traditionally been currently drafted, exclude from its scope authorised payment institutions and electronic money institutions. So it wouldn't take a genius to work out, with things the way they stood, that if someone wanted to evade tax, they could hide their wealth in an electronic money institution or a payment institution rather than a bank, as PIs and EIs are not required to report this information to tax authorities, so that can be shared amongst tax authorities globally. Accordingly, amendments have been made to the ITC regs to fill this gap by extending the definition of reporting financial institution to require other types of financial institutions, excuse me, to comply with the ITC regs. If following the changes, the PI or the EMI that you work for is deemed to be a reporting financial institution, then that payment institution or electronic money institution will obviously have to comply with the requirements set out in the ITC regs. So what are the changes to the scope of the Common Reporting Standards? So as I mentioned before, a reporting financial institution has to comply with the ITC regs. Now, the term reporting financial institution encapsulates the term financial institution. The term financial institution encapsulates the term depository institution. Now, the term depository institution, as a result of the changes, will include entities which hold a specific electronic money product. Previously, a depository institution was defined as any entity that accepts deposits in the ordinary course of banking or similar business, i.e. a bank. However, as a result of the ITC regs changes, it will now include firms which hold a specified electronic money product. So if your PI or EMI holds a specified electronic money product, then they will be deemed to be a depository institution, and most likely they'll be deemed to be a financial institution, and most likely they'll be deemed to be a reporting financial institution and have to comply with the reporting obligations to HMRC. So it's obviously important to work out what a specified electronic money product is. As you can see from the slide, a specified electronic money product is defined as digital representations of a single fiat currency that are issued on receipt of funds for the purpose of making payment transactions, that are represented by a claim on the issuer, denominated in the same fiat currency that are accepted by a natural or legal person other than the issuer, and that by virtue of the regulatory requirements to which the issuer is subject, are redeemable at par value for the same fiat currency upon request of the holder of the product. Now, this definition, I'm sure many of you picked up, closely mirrors the definition of electronic money found in the electronic money regulations, which I have here. So the electronic money is defined in the electronic money regulations as an electronically stored monetary value as represented by a claim on the electronic money issuer, which is issued on receipt of funds for the purpose of making payment transactions and is accepted by a person other than the electronic money issuer. So you see I've highlighted some text in different colors there. The sort of orange text in the definition of electronic money in the electronic money regulations is pretty much the same as the definition of specified electronic money product in the regulations. Similarly, the purple text is the same on both definitions, and the red text is pretty much the same in both definitions. Therefore, it would appear to us that EMIs, as they issue electronic money, fall within scope. Authorised payment institutions will also have to carefully review their model against the definition of specified electronic money products to ascertain whether they might fall within the scope also. We'd be happy to assist you in carrying out such analysis, provide you with a corresponding legal opinion. Now, if you think that you do issue specified electronic money products, then please know that there is a carve-out from the definition. The And the carve-out is if the client funds are held, the carve-out is if the electronic money product is used for the transferring of funds from a customer to another person, which I'm sure many people on this call use electronic money for, like transferring money from one person to another. However, if the client funds are held for more than 60 days, then they cannot fall within this carve-out. If you want to utilize this carve-out, then you have to ensure that your product information and terms and conditions are consistent with this, and you have procedures in place in the event that money is sat in your account for more than 60 days and you have not received a payment instruction from your client. So unless you're 100% confident that you're never going to hold a client's money for more than 60 days, I would say that this carve-out probably won't apply to you. So if you are a reporting financial institution because you do have specified electronic money products, then what do you have to do? You have to provide information to HMRC on an annual basis on reportable accounts which you have issued. So as I mentioned before, reportable accounts are generally accounts held by someone who's resident from outside the UK or a corporate client that you have which receives passive income of more than 40% of its income is passive, and it has controlling persons or UBOs who are based overseas. So you'll have to carry out a lot of due diligence to ascertain, what clients are based overseas. That might be fairly straightforward, and also what clients, which are corporates, have UBOs who are based overseas and only receive passive income. Please note that there are also de minimis requirements. That means if the amount that the account holds does not pass a certain threshold, then it wouldn't be deemed to be a reportable account. However, you need to know that you might have to file a nil return even if none of your clients fall within the definition which would make your accounts reportable accounts. You still have to go through the procedure, carry out the due diligence, and submit a report. So what are your due diligence requirements? So you have to carry out due diligence on accounts that you hold as of the end of December 2025 to ascertain whether or not they are reportable accounts. You will also have to set up new onboarding procedures to ensure that you collect all of the information you require for accounts opened after the 31st of December 2025. So the ITC regs have split up accounts into three general categories: pre-existing accounts with a lower and higher value. Those are accounts that will have been in place before the 31st of December 2025 and belong to individuals. Pre-existing entity accounts, which are accounts held by corporates, which you've held before the end of December 2025, and new individual and entity accounts, which are accounts opened from the 1st of January 2026 onwards. So there's different due diligence requirements and for the various different types of accounts, which you can see set out in this timeline. As I said before, you'll have to make sure your onboarding forms are up to speed by the 1st of January 2026, so that you're collecting all the information that you need to do your reporting. So if we run through the timeline quickly, by the end of December this year, you need to have registered with HMRC. 1st of January 2026 is when the amended regulations come into force, and you'll have to carry out due diligence to ascertain if a new account is reportable, and this is for both entities and individuals. By the end of December 2026, you'll have to carry out due diligence to ascertain if a reportable account is to be pleaded for higher value pre-existing individual accounts. By the end of December 2027, you have to have completed your due diligence for lower value pre-existing accounts and for pre-existing entity accounts. Then on the 31st of May 2027, you'll have to do all your reporting to HMRC on the higher value pre-existing accounts and the new accounts which you have opened during 2026. And then by the 31st of May 2028, you'll again have to report for your 2027 year, then also for your lower value pre-existing individual accounts. Or maybe you're looking at a timeline thinking, I don't have that much to do. But the Electronic Money Association has said it will take 3 years to build a system for operational changes to be introduced. So I think it's imperative on you to work out, as soon as possible if you fall within scope or if you don't. And if you do fall within scope, you need to start speaking to your IT teams about how to change onboarding forms, how to carry out due diligence on existing accounts, and maybe talking to software providers who might be able to collect that information for you. So there is a lot of work to do, and the 31st of December will sneak up very quickly. So we can't, just encourage you to work on that as much as you can. So yes, as I said, your next steps. Do you hold specified electronic money products? Do you fall within the carve-out? You need to work that out. By all means, get in contact with us to give you a legal opinion if you feel like you're on the edge or you want a firm footing to show to your board, which you can rely upon. The legal opinion might be useful to show to HMRC or another regulator if you feel like you fall outside of scope and you want something to show them to say that you got firm legal advice on it. As I said before, you should act now. You need to ascertain what your obligations are under the Common Reporting Standards. You might want to speak to third-party providers about software they can provide you to carry out due diligence on your behalf. You might want to consider updating your privacy policies and terms and conditions to account for any changes that you have to make. You will be collecting some more personal data from your clients, and you will be using it for slightly different purposes than what you collected it for initially. So just be mindful of that. You might need to make some updates to your privacy policy. You have to create an AEOI return with HMRC. As I said, there's, don't underestimate the amount of work involved in getting up to speed on this. So how can we help? We can provide you with a bespoke opinion, setting out whether your PI or EMI falls within scope of the Common Reporting Standards. If you don't fall within scope, then you can use the legal opinion to make this call confidently and stop any nagging feeling that you might have missed something. You can also show it to regulators if you're ever asked about CRS compliance. If your firm is found to fall inside scope of the future CRS, we can provide you with bespoke guidance tailored to your specific business, which will set out how to comply with the newfound reporting and due diligence obligations under the CRS, your data retention obligations, and your self-certification requirements. Now, the Common Reporting Standards and the ITC regs are amongst the most confusing and long-winded legislation I've read in the 22 years I've either been studying or practicing law. Ariana, Gavin, and I have spent more hours than we care to remember studying this legislation and how it might affect EMIs and PIs. We've done the hard yards on this, so please use us if you'd like to. We're part of the CRS working group formed by HMRC, and as a result have direct access to the people who drafted HMRC's guidance on this topic. We therefore think we're well placed to give you good guidance on this and hopefully save you an enormous amount of time compared if you had to wade through the thousands of pages on this from scratch yourselves. So if you want a legal opinion or some guidance, please feel free to get in touch via email or book via the Calendly slot.